U.S. employers added jobs in March, but not as many as they have in recent months. The Labor Department report raised questions about the strength of the economic recovery, the #1 issue in the presidential campaign. President Obama was quick today to put the best face on the weaker-than-expected jobs report.
We welcome today's news that our businesses created another 121,000 jobs last month, and the unemployment rate ticked down.
In fact, the increase in jobs was the smallest since October and well below what was forecast. The economy had added more than 200,000 new jobs in each of the previous 3 months. But in March, the retail sector shed nearly 34,000 positions, and construction companies cut back on hiring. That could be because the mild winter allowed them to do more work in January and February rather than waiting till spring. The unemployment rate did fall to 8.2%, the lowest since January 2009, as many people stopped searching for work. At a White House forum on women in the economy, the president pointed to recent progress while conceding he'd like it to come faster.
Our economy has now created more than 4 million private sector jobs over the past 2 years, and more than 600,000 in the past 3 months alone. But it's clear to every American that there will still be ups and downs along the way, and that we've got a lot more work to do.
But with more than 5 million people out of work for 6 months or longer, the man who wants Mr. Obama's job called the report weak and very troubling. Republican frontrunner Mitt Romney issued a statement saying millions of Americans are paying a high price for President Obama's economic policies. It is increasingly clear the Obama economy is not working, and that after 3 years in office, the president's excuses have run out. Reaction from U.S. financial markets will have to wait till next week. They were closed for the Good Friday holiday. And for more on the jobs picture, we're joined by Greg Ip of The Economist magazine. Thank you for being back with us, Greg.
Pleasure to be here.
So what would you add to flesh out the story of what happened with jobs? And by the way, we should point out most markets were closed. The stock markets were closed. The bond markets were open.
The bond markets were open. And as you may know, bond investors love bad news. And so bond prices were up quite a lot because the employment news was quite a bit worse than expected. I think that there's sort of this troubling feeling of deja vu. Both last year and the year before, the year began with very strong job growth. And then by the summertime, it had petered out. Now, it seemed to have been just because of bad luck. You know, we had the problems in Europe. We had high oil prices because of the Libya uprising. And people thought, well, we're past that now. And the fact that we seem to be going through that cycle again is very troubling. However, there's some reasons, I think, to expect that this was not the sign of an economy that's about to flatline. First of all, 120,000 is not a bad number. It's just bad because we were expecting so much better. Second of all, we do have some other data about how the economy is doing, such as the weekly number of people looking for unemployment insurance benefits. Those numbers are dropping. We have some survey data from factory managers. Those numbers suggest that things are getting better. So I think it is probably the case the economy is still on track. Possibly what we've seen is a number that's a bit of a payback for employment growth that was stronger than we could sustain for a little while.
So I was reading one analyst today who said, yes, it's disappointing, but he said, when you look under the hood, the numbers are a little bit better. So is that the kind of thing you're talking about then?
A little bit. So, for example, if you look at sector by sector, manufacturing was up quite a lot. And since manufacturing has been so hard hit, it is encouraging to see that that sector continues to make progress. If you look at the number of hours that people work, they did not go down. Why does that matter? Well, because if firms really thought business was slowing down, they would start cutting back on the hours of their employees. So it's little things like that that suggest this is not a really bad report.
So again, on the comparisons people have made that you just brought up to last year and the year before, you're saying you see something materially different this year.
I do think it's a little bit better. Now, there are still risks out there like petroleum, like the possibility of an attack on Iran that drives up the price of oil, and Europe still is stumbling through its problems, as Europe tends to do. However, at least so far, gasoline is not up as much in percentage terms as it was a year ago. And it does look like, although Europe is still in recession, they have sort of eliminated the worst possible scenarios for this year.
Greg, what about the fact the unemployment rate did drop? It was just 0.1%. But is there any significance to that?
Well, there's a little bit of significance. The unemployment rate has been dropping faster than we can explain for the last 5 or 6 months. You know, economists will tell you that the 1 percentage point drop we've had in that rate in the last 4 or 5 months would normally be associated with an economy growing at around a 5% rate. And in fact, at best, we're only growing around half that rate. They don't really understand why it's dropping so fast. Part of it is that people are dropping out of the labor force and they're not looking for work, but we don't really know why they're dropping out. They're not actually saying that they're just discouraged. They're just not looking any longer. Some of them have gone back to school. Some of them have retired. Some of them may have been unemployed so long they've gone on disability and will never work again. And if that's true, then we have lost a big chunk of our labor force, possibly forever, and that is a real tragedy.
And in fact, I was going to ask you about that because you look at these people, and it's a large percentage of those folks who are out of work. On the horizon for them is what?
It's very hard to tell. I mean, economists really debate why is it that so many of the unemployed are unemployed for so long? Is it because they just don't have the skills necessary for the jobs that are out there? Is it because they can't sell their houses and move to the cities where there are jobs? I think probably the best explanation is just that the economy has been so sluggish. And by the way, we know that that is normal after a financial crisis. And it has been so sluggish that the sales have not been there for businesses to hire a lot. And so the people that they don't hire spend longer unemployed.
Now, there's one other thing I want to, and I should say that we have a report coming up shortly on the program, Paul Salmon, who will look at this disconnect between employers looking and people looking for work. But one other thing is the Federal Reserve. I mean, the open.
Yes.
The Open Markets Committee.
Sure. Yeah.
What's the name of it?
It's the Federal Open Market Committee.
Federal Open Market Committee, thank you, has met. The feeling seems to be coming out of there that the economy doesn't need stimulus right now. But with jobs numbers like these, could that change?
If we have a few more months like this, yes, it could change. I mean, just in the last few days, we got a report on what they talked about at their last meeting 3 weeks ago. And what surprised the markets was that there was almost no support among the membership of the Federal Open Market Committee for another round of so-called quantitative easing. This is when the Fed basically prints a lot of money and uses it to buy bonds. And when they buy bonds, they push down long-term interest rates, and that's supposed to stimulate the economy. Why so little support? Well, partly because the numbers had been quite good, as we were just talking about, 3 or 4 months of very strong job growth. That said, Ben Bernanke, the Fed chairman, last week did warn that he thought that the numbers would not stay that good for so long. If the numbers are as weak as they were in March for a sustained period of time, we will start to see the Fed, talk about perhaps firing up the printing presses again.
So in a way, these jobs numbers we see today, in a way bear out what Ben Bernanke was saying.
Yeah, they really do.
Greg Ip, thank you very much.
Thanks for having me.